And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Welcome to today's edition of The Real Investment Show. It's our continuing interview series, and today we're very blessed to have James Garrett Baldwin join us. He's an economist in Maryland, the author of Me and the Money Printer. He hosts a free 8:45 a.m. show called Theo Trade every morning, and he strives to work on keeping people updated about what's going on in economics and investing and markets. 15 years of experience in financial publishing, competitive market intelligence, corporate advocacy, financial planning, author of the novel The Man with the Big Red Balloon. I guess that's Jerome Powell. Consultant editor, writer of education from Northwestern University, Johns Hopkins University, Purdue University, Indiana University. Man's been there, done it all. James, welcome to the show today. How are you?
Thanks so much, Lance. It's really a joy to be here. I've obviously loved your work for years, and it's very humbling to be having a conversation with you today about the world, which we're both trying to figure out how it works. It seems one day at a time.
Yeah, no, absolutely. And by the way, just for our viewers today, be sure to like and subscribe to the channel while you're watching this video. It certainly helps us a lot and certainly helps us get great guests like James here on the show. So your input's greatly needed. But this conversation started out as a Substack battle between me and James. I shouldn't even say battle. I wrote an article a couple of weeks ago about debasement and talking about money printing in the economy and money supply. And James wrote a very thoughtful rebuttal to my article, which really kind of brought to focus, I think, a topic that everybody's struggling to figure out, which is this whole idea of M2 money supply. Lots of headline articles about, the size of the deficit and the running increase in the money supply, and it's going to all end in doomed and disaster, and it's going to all be terrible. We get into the Fed and quantitative easing, quantitative tightening, and there's just a lot of things that are more of a kind of a mystic veil for a lot of investors that are just trying to figure how all this works. And I thought it'd just be a great opportunity for you and I just to kind of talk about some of the different facets of how money's created in the system, where it goes, talk about wealth inequality and some of the things that Fed policy have led to in this economy. We see a lot of the angst of the younger generation coming up. They can't buy a house, they can't afford things. And this has all been the direct result of monetary policies over the last 15 years that have led us to this end result. And there doesn't really just seem to be a good solution. So I thought we could kind of start with some of the basics and then just kind of work our way through these topics.
Yeah, absolutely. And when I replied back to you, you were very gentle in your reply back to me. I appreciate it. But there is one kind of starting point, and I think that this kind of frames the conversation and frames the debate. Me and the Money Printer, which is my Substack, it is very tongue-in-cheek, and it is still, I agree with you. Like we are not literally printing money. The Federal Reserve is marking up reserve accounts. Right. But when I talk about money printing, I had put it within two frameworks. The first is that I'm describing the Fed's ability to create unlimited digital reserves to purchase government debt, and you answered that in great detail. But there's the second part, and that is how Treasury operations affect leverage in the financial system. Yes. And I think that that's really the issue, that people know something's wrong, and I'm arguing that it's not traditional money printing. Right. It really is. It's not about the plumbing itself. It's about what the reserves enable once the Treasury operations collateral chains and the leverage comes into play. So it's not really about the semantics of printing, those crazy pictures of Mnuchin and his wife actually printing money, which like that picture gives me the heebie-jeebies. But it's the transmission. It's how liquidity flows through the financial system and how the multiplication of purchasing power has kind of created where we are today. And I think that that's where I'm trying to frame it, is that I'm not arguing that it's the traditional, that type of printing. I'm arguing that it's the multiplication of claims on dollars. Yes. That is leading to a pseudo debasement rather than the traditional debasement that we've come to know for historical economic analysis.
Right. And I think that's spot on, right? And I think we need to start though at the beginning though, because there are a lot of people that literally think, because you see the graphics that are on the internet of Jerome Powell and Ben Bernanke back in QE1, 2, and they've got the money printer and they're printing out money and it's spewing everywhere. And there is a lot of people that believe the Fed truly is creating money in the system. And part of our conversation is that, just from the base point, just so everybody has an understanding, is that the Fed does not create money. The Fed creates, as James said, they create reserves, and it's an asset swap. So basically the primary dealers, and I've got a graphic for this, so if you'll bring this up, Brent. There's two ways that money's created. This is the way money is actually created. The first is the government. This is the blue box. The government needs money in excess of the revenue they collect. This is the deficit, right? So we spend more than we actually bring in revenue. So how does the government get more money? They issue debt. So as they issue debt, there's basically what's called a primary dealer. These are banks that have guaranteed to show up at the auction. They guarantee to buy the debt from the government, right? And so we see these auctions happen all the time for 1-year treasuries, 5 years, 10 years, 30 years, whatever. There's an auction. And these banks buy, these primary dealers, they buy the debt. So the government gets money. That's how they fund the deficit. The banks now have the collateral. They have the debt, right? And so money's now been created. The government has now created money by selling bonds. Now, this is where the Fed steps in. The Fed then says, okay, I need to create more liquidity for banks. This is where we talk about bank reserves. This is where we talk about QE, quantitative easing, quantitative tightening as of late. And so the banks have the bonds. The bonds that the banks own now, they have a couple of ways to dispose of those. They can sell those off to investors, hedge funds, money market funds, whatever. Or they can sell them to the Federal Reserve. The Federal Reserve credits their bank reserve account with the amount of credits equal to the amount of debt that they're buying. It's just an asset swap. So it's just a debit and a credit. This is all that occurs. Now the banks have more reserves. And how do banks create money? Banks loan money into the economy. So they loan money to individuals, businesses, hedge funds, money market funds. They loan money out into the system. And this is part of where we're going to get to what James just brought up a second ago, which is kind of the shadow banking side of the industry, which is the leverage that's created throughout the system through some of these operations. But I wrote an article that discussed a little bit of this, and I wrote about this on last Friday. It's called Money Printing by the Fed, Fact or Fiction. And there's two important points about this, is that one, all money is lent into existence. So there's just to clarify the point, nobody's literally sitting around with a money press printing out dollars and throwing them out to the system. Yes, we do print currency. That's a very small fraction. That's the money you have in your wallet. So your ones, your fives, your tens, your 20s, we do print those. That currency does get printed. It is a function of the debt that was issued to create the money to print that currency, but it's a very small percentage of the money actually in circulation. So that's the only printing that's going on. Everything else is lent to existence. But importantly, when it comes to these operations, and we're going to get into a little bit here in a minute, is talking about repo operations and liquidity repurchase operations. Without repo, Wall Street does not open. Right. So there is a very important dynamic that goes on in the system of the Fed creating reserves. And so again, this is very important. But the primary issue, and then we're going to get the rest of our conversation, is that I just want to clarify for our viewers that there is a lot of misstatements out there that the Fed's printing money, and that's not the case, right? So we loan money into existence. So now we can move forward.
Yes, but I do want to preface this a little bit, because there was something that happened in the last 20 years. You might have heard of it, right? Everybody, the great financial crisis of 2008, and the system shifted. It stopped being more deposit driven, commercial bank money creation through loans and deposit, and became effectively far more collateral driven. Which we'll get through the repo and the derivatives and the wholesale markets. And there were four things that really occurred. QE really replaced deposits with collateral. So after 2008, the Fed flooded the system with reserves. The real limited credit stops being deposits, and I would argue that it became the supply of treasuries and MBS that could be used for collateral for borrowing and lending. Then shadow banking, and Sultan Posner pointed this out in 2008, shadow banking, the money creation outside traditional banks. It's hedge funds, it's dealers, it's money markets. They fund themselves through the repo and derivatives. All of this is collateral based. It's not truly deposit based. Then regulations made Treasury, a very critical form of money. Post-crisis rules like Basel III, Dodd-Frank, that forced banks to hold more high quality collateral, which basically turned U.S. debt into the system's base money. And then 3 or 4, the Treasury and the Fed are running a very similar joint liquidity machine. And I go back to what was the key thing for me as I try to make sense of this. And again, I spent a lot of time in graduate school. I view the world through liquidity, momentum, and insider buying. And we can get to that in a moment. But something happened fundamentally in 2023, and I couldn't figure it out. We were under the impression that when the Federal Reserve reduces its balance sheet, and we'll explain that as well, when it reduces its balance sheet, that drives equity markets lower. In fact, we were around 3,800 on the S&P 500 back in late 2022 after the gilt crisis in England. And the expectation from some very smart people were that we were going to go down to 3,250 because interest rates were going to be elevated. And then all of a sudden, a guy like Michael Howe comes along and writes an article in the Financial Times and says, well, the liquidity bottom is in. The Treasury is going to take over. The Treasury is going to issue debt. The Fed's going to monetize it or backstop it. And then Wall Street is going to rehypothecate it. And all of a sudden, the S&P 500 goes up 200 or 20% that year. And it basically shifted my view of the Fed is the driver of the markets, which a lot of people viewed from 2008 through 2014 and into 2020, and that the Treasury Department has really been a core driver of equity performance in the last 2 years because of the leverage in the system.
No, you're absolutely right. And this is where we're going to get into wealth inequality here in just a few minutes. But here's I want to step back on something you said because it's really important. This all started back in 1999. And it was a very subtle shift at the beginning. So Alan Greenspan was worried about Y2K, and he was worried about, this inflation boogeyman that was right around the corner. And of course, there wasn't an inflation boogeyman there. And started cutting rates and started pushing adjustable rate mortgages and all these type of things. And so I want to show you a chart because this is something you brought up in your response, talking about the inequality and things that are occurring within the system. So what this is a chart of, the red line is the velocity of money, right? So it's how fast does money move through the economic system? And if money is flowing through the economic system at a reasonable pace, it should be bolstering the vast majority of the economy. So back from 1960 all the way through 1980, you kind of had a rising monetary velocity. The economy was doing fine. We're growing at 6, 7, 8%. It was all good. But beginning really in the late 90s, this all shifted and you'll notice that the acceleration to the downside occurred in 2007 when we started doing exactly what you're doing. We started shifting from a deposit-based economy to a collateral-based economy, increasing leverage. And what was happening is that money wasn't flowing through the economic system. In other words, the banks weren't going out and going, hey, I'm going to loan Brent over here, $100,000 to go buy a house or whatever. Why would I loan Brent $100,000 to buy a house at a 3% mortgage rate for 30 years when I can loan it to hedge funds or overnight repo markets, et cetera, at a much higher rate, right? And so and to your point in your article, is that something broke economically, and this is why we can't create stronger rates of economic growth. And that's why the spurt we saw after COVID, where we sent checks to households and people went out and bought stuff, even though we weren't producing anything, we saw monetary velocity pick up momentarily, but that's going to roll over and start dying again because economic growth is slowing back down. But this is exactly what you're addressing, is that the transmission system of the economy is broken. And that has yet to be repaired. And nobody's addressing this. We've moved into an environment where nobody really cares about the bottom 50, really 60, 70, 80% of the economy. They're over there just doing their thing. We're just really focusing on the top 20% of the economy.
And I think it's important to note, right, the velocity doesn't disappear. It migrates. Instead of it turning onto Main Street, it churns into Wall Street collateral chains. And that's effectively why I think M2 fell off a cliff after 2007. But it's it's fascinating to see this. And one of the things that I was looking at a statistic before I got here, and I'm going to pull it up in a minute. But basically, all of this leverage in the system, we've gone from 2x on financial wealth in 1980 to 6 times. So that money is trapped. And the question is, how do you fix this? I don't know what this would be. You have to stabilize the plumbing. You maybe have to issue smarter collateral. Maybe you have to put different guardrails up on shadow leverage, but I don't know how they're going to ever do that because the Bureau of International Settlements, or Bank for International Settlements, says basically the Fed is trapped. He said that in April 2025. They argued that what happened last year with Japan in August of 2024, that it's gotten to the point now where we have to check in with Brussels and Frankfurt and Tokyo before we can do anything with our monetary policy. And you mentioned the 1990s. I think that there was a lot of things that happened. I go back to 1993 on a regular basis. And I argue that 1993 is kind of like the seminal year of where we are now. Now, obviously, 2008 happened. We had the 1999 changes in laws, but 6 things happened in 1993. We started inflation targeting, and we didn't tell anybody for 17 years, right? We never admitted it. I think Bernanke said something in 2003, but it doesn't become a formal policy. So that's the first thing. Secondly, they changed the financial incentives of the stock market, where they tried to change the law for CEOs that they couldn't take taxes over $1 million. So what did they do? Everybody started getting paid in stock and options. The CEO to pay to the average worker went from 30 to 1 to 300 to 1 in 5 years after they made that change. That's what they were trying to fix. So that's the notion of good intentions. They put Al Gore in charge of supply side policy as a reaction to something that happened under the Bush administration, but that was a major law that has effectively locked up our ability to do big scale projects here in the United States without having to spend a ton of money on all different types of mitigation. Then you put Robert Rubin on the economic advisors. You know how that ends up, because he takes over the Treasury Department and ultimately goes to Citigroup. That was a significant development. You had Cuomo go to the House, the HUD, around 1993, and then he runs it, and he forces Fannie and Freddie to basically flood the system with financial support for the housing system. And then something else you wrote about recently. It was the onset of passive investing. Right. 1993, the very first passive fund, the SPY, comes up. And the SPY is a great product, but let's talk about what has happened since that period of time. Michael Howe pointed this out the other day. He noted that back in the 1990s, about 80% of investors were value arbitrage investors. I have a thesis. I think this company is I'm going to buy it for $1. I'm going to sell it for $2 in a couple of years. That number has collapsed apparently down to about 15 to 20%. Right. Passive investing was 5%. Today it's 50. So what's the last third? It's leveraged investors. That's gone from about 10%, 10 to 15% to roughly 33%. And if you want to see in real time leverage leaving the system and basically all the rehypothecation and what we're talking about, where the idea in the repo market, where it is I can have $100 million. I can go out, I can buy a ton of short-term T-bills. I could take it back to the repo market. 70% of the time, no haircut, get $60 billion back, buy more treasuries, leverage that up. Yep. Now I take the other 40 and I go out and I buy FANG stocks. They're very liquid. That creates leverage. You have the passive support. Okay, look at the FNGD. Pull that chart up and look at it in August of last year and look at that in April of this year. The FNGD, when it breaks its 50-day moving average, that's leverage leaving the system. And that's how we have these very violent unwinds that have transpired during the gilt crisis, during 2022, during the largest hedge fund sell-off in 15 years, June 8th of that year. We had what happened last year with the Nikkei, what happened this year with the trade event. And every single time you have these unwinds, and then what happens? They have to create some level of accommodation through policy support. Right. And whether that is fiscal policy, monetary policy, or trade policy. The insiders, if you look at insider buying to selling on an aggregate level, have called the bottom of every single crisis back to 2008. and just called the bottom on April 8th and just called the bottom last August. It has been the same process of just deleveraging and then policy accommodation and leveraging back up. And we can't break that cycle.
Yeah, I know. And this is, and again, this is part of the what we were talking about before, this kind of wealth inequality that's got built.
Right.
This is a chart right here, just to show you what James is talking about. This is a chart showing and this is inflation adjusted. So this is real household equity ownership by brackets. And the green is the top 1%. The purple is the top 10%. The orange is the middle kind of 80 to 90%. And 50 to 90%. And then you can't even see it. The bottom 50% is there, but it's minuscule. And you'll notice that there's been no real equity ownership growth for the middle 50 to really 90%. It's minute. It's about the same level it was in 1998. But you've seen this massive explosion in wealth for the top 10% of income earners. In fact, the top 10% of income earners own almost 90% of the entire equity market. So, but again, they're participating in the markets. That money fuels into hedge funds and pension funds and everybody else, which is exactly doing what you're doing in order to create returns. They're taking on more leverage, and the cycle just repeats itself. And so, the fix to this, Michael Leibowitz and I were just having this conversation this morning. We can look at something like the housing market, right? The housing market's a great example of what's going on. Is that housing was very affordable for decades, and grew at about 3% a year all the way through really kind of the year 2000. And then Alan Greenspan comes along and says, hey, you know what? We need to do more adjustable rate mortgages. And let's get more people. And this was in collusion with the housing industry and the National Association of Realtors, and everybody else was all colluding in this to get more homes sold to people, whether or not they could afford them or not was kind of irrelevant. Let's just get them sold. And of course, then we came up with subprime mortgages, and we came up with no income, no job mortgages. And we created this massive demand in houses that supply couldn't keep up with. So naturally, house prices rose. Well, we're still doing that. Fannie Mae still has a 3% down payment for houses. We're still seeing, they were just talking about yesterday actually, floated this idea of a 50-year mortgage, right? So now think about this.
It says everything.
Yeah. If you get a 50-year mortgage, a $500,000 house, you get a 50-year mortgage, you're going to pay $550,000 in interest over 50 years. You're going to pay more for the house in interest over 50 years than the house itself. And so, but doing that, right, I can get a lower rate. It's 50 years, so my monthly payment is lower. Great, I can buy a house. But you're not solving your demand supply problem. This is the same problem in the financial markets. We're creating more and more product, 3x leveraged ETFs. Now we're doing 5x leveraged ETFs. It's not about what's good for investors. It's about what makes money for Wall Street.
100%. And the 50-year mortgage concept, I used to consult for one of the big FSCs or GSEs, and I started a project, and I was given a deck from my boss that it was basically arguments to increase housing supply in the United States and how to do it. And a lot of the stuff is in the land, the lumber, the labor. But there was one chart, and I'm going through it, and I'm on like chart 14, and I look at it, and I'm reading this sentence, and I said, this can't be right. There are 25,000 groups, effectively regulators, bodies in the United States that oversee the zoning of housing. Local, municipal, state, U.S. government, 25,000. And everybody is protecting their own little turf. Everybody's got that little bit of power. And then you have the strength of not in my backyard. So instead of finding ways to make housing more affordable through supply, or maybe even in neighborhoods where you could have a company like Meritage or Cathco put up homes that look like the traditional brick and sticks that are cheaper. Nobody wants that because that might impact their housing value. That'll impact taxes as well. A lot of governments obviously have to pay for schools and other things through that taxation. So what do? We financialize it. Right. That's the solution. We go, okay, well, let's just make it 50 years. And I laughed because I know that that was on the docket for 40 years under the Harris administration. So The new group comes in and goes, we'll raise you to 50, which again is insane. But you're absolutely right. It speaks exactly to financial incentives in the financial markets. I used to talk about a friend of mine who I went to college with, smartest guy I ever met. LSAT perfect, GMAT perfect on his SATs. 30, 50 years ago, this guy would have been building bridges. Now he's a very prominent lawyer. Well, law there's an incentive to go into law in the United States. It is a very lucrative industry. Well, now, what's the incentive on Wall Street? Is it to actually manage money, or is it to collect 2% on an ETF that replicates the S&P 500? And if you want to see something really funny and just silly, I always go back to it. There's an ETF. It's called CATH. It's the S&P 500 Catholic Values ETF. And this was founded as, we're going to only thematically invest in companies that bestow Catholic values. People didn't buy it. So what did they do? They took their pool of money and they just bought all the FANG stocks, and they just changed the name. And that's all it is. And there's 1,200 of these things, right? So this is why as much crap as people give Kathy Wood, at least she's sticking with the thematic. She's not just going, you know what, I'm just going to put it into the SPY. Right. But that's what a lot of people do. And there's a lot of these things. And it just speaks to incentives. Our smartest engineers are not building bridges. They're creating leveraged ETFs around Nvidia. Yeah.
Well, and again, this also goes back to, the conversation earlier about passive indexing, is that, again, and this is, I've told this story before, but, I started investing, way back. My financial career goes back to pre-crash in '87. And, I remember at that time, nobody talked about mutual funds. There was a few mutual funds on the streets. There was American funds and a couple others, but there was probably a handful of mutual funds that were out there. And you had what was called a stockbroker, and you called us. And when I was growing up, your father would tell their daughters, when you grow up, marry a doctor, a lawyer, or a stockbroker. Now it's like, don't marry any of the three. But back then there was a valued profession because they were, to your point, they were looking at stocks, they were investing on a thesis, and they were holding for 6 or 7 years for that thesis to work out. And then somebody on Wall Street, I can just almost envision it, right? That there was this meeting at Merrill Lynch, back in the early 80s and early 90s. And they said, I don't know, all these stockbrokers trying to pay them commissions. Every day they go out and sell stuff. If they don't sell stuff, we don't make money. What if we just annuitize our business and tell everybody they need to buy and hold and go buy mutual funds? We just charge them 2% a year, and we collect that annuity fee every January 1st. Where what we made for the year on $100 million, we make $2 million, great. And we just tell them to buy and hold. And forget all these stockbrokers. We don't need them anymore. We'll call them financial advisors and just have them push everything into mutual funds. And then mutual funds were too expensive, so now we created ETFs, which are exactly the same thing. And now nobody works. It's just buy an ETF, and you have 484 ETFs that own Apple. So every time somebody buys one of those ETFs, it just drives the price of Apple up, which makes more people buy S&P 500 ETFs. And so it's this it's this mindless robot, as Michael Green puts it, that is just driving the markets higher. Valuations are a problem. The wealth inequality is a problem. This is all going to have, transformative effects when something eventually, I don't know whatever causes it, but there will be something that happens that causes a reversal. And the financial impact of that reversal is it's going to impact the top 10 or 20%. They're going to be fine. Yeah. They have plenty of wealth. It's going to devastate the bottom 50% of the economy.
I think that there's if you are a person who follows the liquidity cycles, if you're a believer of what Michael Howe writes or what Posner writes, then you would be looking out to 2026, 2027, and being concerned about this cycle hitting its peak and the refinancing wall that would be coming, and what would potentially be the thing that I think Diamond kind of hit the nail on the head, except that sometimes I get a little tired of hearing Diamond complain about crisis when JP Morgan benefits more than anybody when the printer goes back on.
Right.
But I think he was right. It's effectively like, okay, we can't get anybody to buy this debt anymore. We've gone from, since 2017, when the Tax Cuts and Jobs Act opened, for short duration bills, which is what fuels that rehypothecation, what fuels that repo, 11% of issuance to now 21%. Bank of America is saying 25%. I think it comes when nobody wants the bills. Like, nobody wants to be up at the front end of the curve. And that's kind of where we're getting into this, financial alchemy, this, and that's the wrong term, but, financial engineering of, hey, let's just make all the stable coins out of the short-term debt. And we at the Fed, we can focus on the 10-year and the 20-year, and maybe, possibly, and this is kind of my thesis for where this is ultimately going to end up, another version of my IRA, which is what the Obama administration tried to do, where basically they say everybody gets a retirement account, but the only thing that you can own is 30-year bonds. And that's not a retirement account. That's a loan to a government with a very serious spending problem. But if they force the public to own the debt, which I think is one of the last big options. One other thing that I did want to point on was the Buffett Indicator, because I see this pop up on Real Investment Advice a lot, and you talk about the moves to the second standard deviation happening in the 60s, and then obviously in 2000 we've hit that upper bound 2 times. How do you got to be banging your head against the door, because I get the sense that you're a little bit more of an old school value arbitrage guy, and I love that world, but I keep trying to go back in and look at equities and say, like, what's this thing actually worth?
Right.
And we just continue to see this thing go up and up and up and up, like it's the guy changing prices on a gas station in a hurricane. No,
seriously, it's a huge problem. And Mike and I are both old school fundamental guys. And so and I just wrote an article on Monday, actually talking about the very basics of valuations and forward math. And you look at CAPE ratios where we are now, forward math on 20-year returns are around 3%. Forward returns on 10 years is about -2. And but yet the markets are just going up and up and up. And the problem is really twofold. Is that we pay very close attention to this, but we also realize that we have to deal with the market that we have. Right. So John Hussman is one of the guys that I think is one of the smartest guys on the planet, right? And for years, he underperformed the markets massively because he was after the financial crisis, because he was holding on to these fundamental valuations. Right. And he was very true to his discipline, and I applaud him for that. But as for me, running a company that invests money for other people depending on it for retirement, I could sit in cash and money markets and treasury bonds right now and say, look, I can't be in stocks. They're just too expensive because they're going to crash someday. And I would have been wrong for 15 years. And, my clients would be so far off with their financial goals. So we are forced, regardless of where the valuations are. And this is the hard part. This is the hardest part of investing in this market cycle that I've ever been in. Is that you have to remain invested to participate in, which is forcing you into a group of stocks that you don't really want to be in, but you almost have to do it.
Yeah, and Druckenmiller pointed this out in 2018. He was talking about how the fact that there's really no downtrend in the market, because the second you move into the third standard deviation of price, algos are stepping in and buying stuff, and it's completely throwing off your thesis. And when a guy who beats the market 30 years in a row at 30% a year, is throwing up his hands, that's where I kind of have to say, all right, you're right. I have to focus on the market that I have. But the thing that I want to just go back to real quickly is, the idea of debasement, the construct of debasement. I think the argument is that's where the debasement is. And you can define it in a different term, but it's happening in asset prices. It's happening in housing. It's happening in land. Your money is buying less of future output, which is supposed to be the core wealth engine of the United States. And that's completely out the window. And unfortunately, the question is if this cracks or when it cracks, what it looks like. And it will be, I would argue very comparable to 2022, very comparable to 2020. It will be very sharp and very violent. And that's why I try to simplify things and say, watch the FNGD, because that's the leverage. That's the market that we are dealing with today, breaking down when that is breaking out. And that is not a way that I would have been viewing financial markets in the 2000s or even up to 2017.
Right. Well, no, and again, but I want to step back on the word debasement here just real quick. Mm-hmm. I'm not arguing with you at all, but I just but when debasement has been
term.
Well, it's just been thrown around the media.
Yeah.
Like crazy, particularly over the last year. Just gold's going up, so it obviously means debasement. I just want for our viewers, there's debasement is really not the right word anymore. Debasement,
it's not. It
really refers back to when Rome, as an example, issued their currency, and it was made out of silver coins, and they took silver out of the coin. They put less silver in the coin to pay their debts. You're debasing the currency at that point. We don't do that anymore. We're a fiat currency. I mean, I can take a dollar bill, here, I'll just give you a good example, right? So here's $20 bill. I know people don't really see these anymore, but this is what currency actually looks like, just in case you've forgotten. But I can tear the corner. I can tear the corner off of this $20 bill, and I can still go to now. Technically, I've debased the currency, right? Because I've taken.
Technically, you've broken the law.
Yeah, technically, I've broken the law. But it will still work. It will still get me $20 worth of goods. Now, the reason I make this clarification is for this reason, because what we're really talking about here is inflation. And if I had, in fact, I think I might have a chart here real quick just to kind of, here it is. So this is the chart that people typically use when they talk about debasement. This is the purchasing power of a dollar of the purchase of a good or service. So in 1966, it would buy me $1 worth of a can of green beans. Today, it would buy me basically about 10 cents of those green beans, right? And so people talk about debasement. Oh, see, it's debased. It's lost its value. Well, it only lost its value if that $1 was in a jar that whole period of time, right? So the dollar in 1966, if I pulled it out of the jar today, won't buy me the same amount of goods and services because of inflation, and inflation has gone up. And so this is why this is the importance of investing, and why, regardless of where you are in life, this is why it's so important to invest your dollars so that they are growing at the rate of inflation over time. And, you can invest in gold, but gold was a terrible hedge for inflation until 2006. It didn't start outperforming inflation from the 1970s until 2006. Stocks have been a great hedge for performance, but again, now we're back to valuations. And so one of the challenges and this is now back to your point, James, is you're right. Asset price inflation, not just in stocks, houses, cars, everything, right? The worst thing that we could have done during the pandemic was send checks to households, because it created demand when you had no supply available, and created this asset price inflation across all levels of the household living standard, which has now made things so difficult. And this is why I understand the Gen Zs, the millennials complaining about the economy. Trump's economic approval rating is falling because of exactly these policies, and nobody's willing to look back and go, look, we can fix this. James, we can fix the housing problem. We have to get supply and demand back in balance. How do we do that? 20% down payment, no split mortgage, and you have to qualify for it. You got to have a good credit rating.
Right.
You do that, it's going to be terrible. House prices are going to collapse. You're going to get house prices down. Nobody's going to be able to afford it for a while. It's going to be terrible, right?
Yep.
But that's the only way you're going to fix it, is to return back to rational monetary and policy standards. Both Fed policy, governmental policy have to return back to rationality about how money really works in the economy.
Right. And again, you go back to just the idea that we aren't paying off debt. We refinance. It's a refinancing mechanism in the financial system. And that, again, you're right, debasement might not be the core term, but I'm trying to fuse this. I'm trying to find a way to help people understand that, if you literally take that M2 and that GDP line and you put it up there, that's a 2D world. But the second that you see where the money is stuck in the plumbing, and you see these spikes of repo, and you see the rehypothecation, you see the leverage, the reality is you can let this leverage go, and that would effectively end the debasement argument that I have.
Yep.
But that is going to be a very ugly unwind, and that is why the Ben Bernankes of the world and the Yellens of the world have come in with a helicopter and dropped money from the sky, and why the Treasury Department has shifted toward a more front-end focus. And I try to describe this the right way. I wrote a report in early 2024, and we called it the Hedge of Tomorrow. And basically, we were just arguing that all roads point to more, not debasement, but more monetary inflation, more efforts, monetary and fiscal deficits that are going to continue to rise. And what we started to do was look back at history of different crises that have occurred, different people who have tried to confront central banks over time, and look at like what actually did the wealthiest class buy. And what we're coming to find is, through very turbulent political times, it's always the same thing. It's geographic diversification. So people are buying, back during the Caesar years, they were buying grain estates, they were buying Spanish silver mines, they were buying Gallic timber operations. They were always flexible around whoever was in charge. Ideology was not what they cared about. They worried about being adaptive. So you wonder why like hedge fund managers are now extending olive branches to Mondami, because they'll play every angle necessary. Infrastructure, toll roads, urban real estate, manufacturing facilities, creditor positions, lending money out. And the reality is, like, this is kind of the modern sovereign approach to looking at this and saying there is a real issue today. And I know that you've argued that central banks weren't buying gold because of the debasement, but it's very clear that the sovereign funds are hedging their bets very, very clearly right now. And I think that that's where my focus is over the next 2 to 3 years.
Yeah, well, no, and look, if I'm a sovereign fund, and this is my point, right, is that central banks don't buy gold just because they're worried about the world moving away from the dollar, because that's not happening.
Sure.
They buy gold because in this environment, if I've got to store reserve currencies, which I do, and if I have dollar denominated assets, which I do, I want to make sure that if the dollar is declining in value, and right now, we're trading right around 100, which is fair value for the dollar. If it's above or below that mark, well, when it's below, I need to make sure that I'm hedging that dollar risk. And so I buy an asset price that's going up, which was gold, right? Because bonds were under pressure because of interest rates. So it makes complete sense as to why, these individuals were buying gold. My problem is the people hawking the gold is make all these kind of bodacious claims. It's like, oh, central banks are hoarding all the gold, and no, they're not at all. And just but you need to buy my gold, right? I've got gold to sell you, so make sure and buy gold for me. It's like, well, if gold's where you're supposed to be, why are you selling your gold, right? So, I just always want people listening to say, just to think rationally about how asset works, because money is always chasing a return, and no matter who it is, everybody's trying to make a return on their money. And for central banks and for sovereign funds that have to hold U.S. assets, they have to hedge those assets. And just like I buy puts in a portfolio, right? I'm hedging my risk. Same thing they do there. So, in the end, your view is right. Over the next 2 or 3 years, that's probably going to be a base trade here for a while. So I agree with you.
It definitely should. And I think if you look back and you assess this has been such a surreal 5 years. Yeah. A lot of the rules broke, and you had to adapt very, very quickly in ways that I never necessarily would have thought that I would be here, because, I was old school MBA finance, focusing on, how do you look at a company the way that Buffett assesses a company, and then being in an environment where Nvidia has just done what Nvidia has done, and then recognizing that, look, Nvidia's had 2 downturns of 33% in the last 14 months. There's something broken, because the fundamentals didn't change, the company didn't change, the market changed, and the players in the market changed. So we have to recognize, and exactly as you said, I really like that line. You have to actually trade the market that you have in front of you. You can't stick and cling to a different asset class or asset strategy, because you might be left behind because of the new paradigm shift that's transpired.
Absolutely. Well, look, I want to spend our last few minutes just to kind of shift gears here, because again, you have a young daughter that you're trying to get interested in finance, and I have 4 kids that I'm trying to get interested in finance. So it's definitely a challenge.
Well, the rule is hire somebody else to do it, right? Because they won't listen to you. But if you hire another coach, they'll pay attention, and somebody will have a game. Yeah, look, my daughter's 7 years old. My father-in-law is Tim Melvin. He's an old school value investor, focuses on the banking sector. It runs in the family. My father did the same thing in the world of finance and business operations. So like it bleeds through us. Like this is what we talk about on Thanksgiving. But my daughter just rolls her eyes and she goes, "Can you guys stop talking about this?" And I try to explain, look, you're going to have to understand money. And my daughter is very good at delaying gratification.
Right.
As we said before we were chatting, the reason that my camera is blurred is because there are just baseball cards all over my floor. I've given my daughter cases of baseball cards because we open cards together, and they're unopened in her room. So she's very good at not having to open things, not having to spend money right away. But it is a challenge, to just even she'll say to me, "I don't need to know this now," and I firmly believe the sooner you start, the sooner, the better off you are. So I'm curious about, what are some easy lessons that I could start to, and things that I could do. And if you have any tricks to trick her into learning, I'll take those too.
Well, so my kids are older. So I've got a 19-year-old, 2 22s, and a 25-year-old. So when they were growing up, I did, and again, I'm not saying the way I did it was the right way, but I could not get them to really care about what the market was doing. And so I really thought about what was important about money for them. And so I started to work on them about learning what's important about money, how to save, how to be charitable, right? How to give, and how to spend, right? Because you do need to be able to spend money. So when I always made them work. We never had an allowance in our house growing up. There always had to be a reward for effort. So that they understood that, hey, I had to perform an effort to earn this money. And so it's got value to it because I had to work for it. When you give somebody something, and this goes with their college education, I make them pay for their own college. And a lot of people are like, "Oh my gosh, that's terrible." It's like, no, because they are invested in their education because they know they've got to pay that debt back at some point. Right. So they now, between you and me, I'm going to obviously help them after they graduate, but they don't know that. And hopefully they don't listen to these podcasts, so they'll never know. But the important thing is that they have a vested value. So when they were growing up, they would earn money, and I would let them spend a third of it. The third of it they had to save, and we kept track of the money they were saving. And then and a third of it they had to give to charity. So I wanted them to learn the value of giving and helping. And so this is just the way we did it. And then when they turned 16 and they wanted a car, they had to work, save. And so part of those savings growing up, that went to the down payment on their car. They had to pay for their own car. They had to pay for their own gas. They had to pay for their maintenance. They had to pay for their insurance. And they had to work. So as soon as they turned 16, they all had to go get jobs. Because again, I wanted them to have value in understanding what was important about money. And now that they've gone through that, so they did the normal stuff, right? They worked at fast food. They waited tables. And what's interesting now is that they look at where they are in life compared to their peers. And they're like, I've been doing like the kids are going like, "Oh my gosh, my car payment's like, I've been paying a car payment for 5 years," right? It's like, this is normal for them. And, I was talking to my son the other day, and he's in college up at Texas A&M. And, I was talking to him, and I was like, "How you doing?" He's like, "Well, I'm having ice soup for dinner." And I'm like, "What do you mean ice soup?" He goes, "Well, I ran out of money on Monday and I don't get paid till Friday." So, but he's having to understand what budgeting is and these type of things. Right. And so it's very interesting. They don't go out, they don't go party with all their friends because they can't afford it because they've got to pay for all these other things. And it's also encouraging them to really focus on what their education is, to make sure that education is going to be financially beneficial for them in the future. So I've got one daughter that's studying medicine at Baylor. I've got a son that's Texas A&M studying computer engineering. I've got an esthetician, and my son's a mechanical engineer over in Europe. So they're doing very, very well for themselves. But, again, I don't know if I did right or wrong. You'll never know. Sure. But now that they're starting to get to the age where, they're looking forward to the future, now they're starting to get interested in investing. And so now we're starting to have those conversations about, let's just start with an S&P index fund. Let's learn how the market operates. Don't worry about Nvidia. Don't worry about Google and what they're doing. I tell them is like, if you'd never seen a car in your life and I walked you out into the garage and there was a completely disassembled car in the garage and I said, okay, put it together. There's your car. You have no idea because you've never seen a car actually function and operate and what it's supposed to look like. So let's learn how the car operates, what makes it go forward, what makes it go backwards. And then once we understand that, then we can start looking at the components, right? And go from there. So we're in that phase of it right now.
That's cool. When I was a kid, so I give my daughter a share of Berkshire B shares every year for Christmas. And that's just to get her, a little bit interested. I know that's a $500 stock. If people want to do that, something similar, look at the SRH Total Return Fund. The ticker is STU. It's a closed-end fund that's basically all Berkshire A stock and Berkshire B stock and JP Morgan and Enterprise and Microsoft. So it's a replication tool that's $20 a share rather than $500. But I was fortunate because my father, when I was 5 years old, my dad taught me how to do 5 things: read a box score in the newspaper, keep score at a baseball game, read a stock ticker. And he worked for McCormick for 35 years. And every day I would get the Baltimore Sun, the business paper, and he would say, "What's the PE ratio?" And I loved it. Right. I also learned how to play gin rummy, and then the last thing, which I shouldn't say to the world, but pour a vodka soda. He would have me bartend for him. But what do those 5 things all have in common? It was all math. Right. It was all division, long division, mathematics, understanding how to calculate a baseball average, things like that. And the stock ticker thing, we don't have newspapers anymore. So maybe I had to just get a copy of the Journal or something that has the Berkshire B stock and basically say to her every day, hey, look at how your investment's doing. And maybe that'll be something that'll spur her a little bit. No, I think it's a great idea. And again, we're kind of getting into that phase right now as well. Look, I can't even I manage my wife's 401k plan. She has no idea it's invested in. So, it's just, there's just some people that are just never going to care, but that's the way it goes. But no, I think, look, I don't know the magic answer for raising smart money kids. This is why John Penn and I do 2 Dads on Money on Tuesdays, is because we're still trying to figure this out ourselves. But I know that what I do know is this, is that when you look at society today and in the future, you have 2 choices. You can complain about the system, how unfair it is, spend everything you make, going to Starbucks and McDonald's and, whatever, and not save any money and then just blame everybody else for your problems. Or you can start to financially plan for your future, start to live below your means, start to save money, start to invest, and start doing the things that lead to better outcomes. It'll maybe never be perfect, but it'll be better than it will be otherwise if you don't. And that's all I do know with certainty. Yeah, you have to be the author of your own life. You can't blame anybody else. And one of the things I always state is you focus on the 3 things: your health, your wealth, and yourself. And until you get those 3 things fixed, don't worry about things you can't control. It's not going to do any good for you, whether it's financial, social, anything else. So that's my little bit of advice, and I try to live by it. But it is very easy to let headlines get to you at times. Yeah, that's why I just get off social media. You'll be so much happier. So 100%. Absolutely. James, thank you so much. James Garrett Baldwin. You can find him on Substack. What's your Substack handle, James? It's the Money Printer. The Money Printer. So on Substack, the Money Printer. Perfect. So at the Money Printer on Substack. You can also follow him on Theo Trade every morning. But definitely go subscribe to Substack. Great stuff. Great guy. And good. Just a lot of really good information there for you. James, thank you so much for your time today. Be sure and like and subscribe to the channel. If you enjoyed today's conversation and our interview series, like and subscribe so we can keep getting more guests like James here on the Real Investment Show. Have a great day. We'll see you back here tomorrow for the next edition of the Real Investment Show.